Hi, I'm Jimmy. In this video, we're going to look at the US economy. We're using a few different economic indicators to see if we can objectively gauge where the economy stands today. And then hopefully we can try to answer the question, should we invest now or wait for another stock market crash? Okay, let's jump right in. So in this series, this is a monthly series that we do. And in this series, it finally hit me this month that we have not been including the yield curve in our monthly economic analysis. So just so we're on the same page, a yield curve is a graph that looks something like this, and it tracks the interest rates, which is on the left side there, for different maturity time periods. A graph that is shaped like this is what they call a normal yield curve. But it's the shape we're after. I know these interest rates are just an example. They're crazy high considering today's environment, but this is just an example. What we care about is the shape of it. It should be upward sloping, which in theory makes sense. The longer we're going to invest for, in theory, the higher the interest rate we should be paid. And just to illustrate how effective the yield curve can be, well, about a year before the stock market crashed, before the financial crisis, this is what the Treasury yield curve looked like back then. And clearly, this is not a normal yield curve. In fact, they call this an inverted yield curve. They call it inverted because, as we might have guessed, well, this is when short-term rates are higher than long-term rates. Now, the running joke amongst many economists is that the yield curve has predicted, it's something like the yield curve has predicted 4 out of the past 3 recessions. Point being, just because there is an inverted yield curve, well, that doesn't necessarily mean a recession will come. But all recent recessions, all recessions for many, many years have been preceded by an inverted yield curve. So, just to illustrate, back in February of 2020, well, this is before the coronavirus happened. This is what their yield curve, this is what the Treasury yield curve looked like back then. This is before everything shut down and before the economy really took a nosedive. And we can say that, yes, this was at least partially inverted. Now, we might also call this on the flatter end, but it certainly is not a normal yield curve, which would be upward sloping. Okay, now that's the backstory of the yield curve. And if we were to fast forward to today, well, this is what the yield curve looks like today. And this is sort of the textbook definition of a normal yield curve. And this is clearly a positive sign for the economy, at least as far as a recession coming in the next 12 to 18 months. Okay, so over to our scorecard here. Well, on our scorecard, the bulls get a point for the yield curve. Now, I also think it's good that we're going to keep this on the monthly economic indicator analysis video, because I do think this is something we should watch, because this is something that tends to change fairly quickly. When we consider what happened in February, after the coronavirus was known about, but before the economy shut down, well, clearly the yield curve was already predicting that. So we're going to want to keep an eye on that. Okay, next up we have consumer confidence. Now, consumer confidence is a crucial part to the overall economy. And since consumer confidence is now off of its highs and it's on the lower end in recent years, well, I think it makes sense to give this point to the bears. I also think that it's possible that this one turns around at some point. But for now, as long as we're stuck in this area here, well, I think it makes more sense to give this point to the bears, since this is a decent way off of its highs. Okay, so back in the scorecard, now we're sitting at 1-1. Next up, we have CEO confidence. And basically, CEO confidence comes from a survey done by the Chief Executive Magazine. And what they do is they ask different CEOs about their expectations about overall business conditions on a scale of 1 to 10, 10 being the highest. And as we can see right now, CEO confidence looks fairly high. So clearly this is going to be a point for the bulls. Okay, next up we have a peek at jobs. First, we're going to look at the initial jobless claims. So just like last month, well, we said it is good that jobless claims are off of its very crazy highs at the peak of the coronavirus pandemic really beginning. But we're still up near 787,000 new jobs lost in the most recent week. So that's way too high to be good, especially when we consider that pre-COVID, well, the numbers were much closer to the 200,000 new jobs a week. So 700,000 is still way too high. So this is going to be a point for the bears. Okay, now we're shifting over to unemployment. Now, unemployment is a bit of a tricky one right here. So we can see that unemployment is in fact falling, which is a good thing. But they're still a bit high considering where the optimal level would be. Before COVID, unemployment was below 4%, which is a good thing. Generally, the target is to get it somewhere below 5%. So until we get in that area, I'm not terribly confident saying that this is a positive sign for the economy. I do think it's good that it is falling, but it's not quite there yet. So I think it actually makes more sense to keep this one as a neutral point. Last month we had this one as a negative point, but I do think it's falling. It's getting close to where we need it to get to. So I do think right now it makes sense to keep this one as a neutral point. So over on our scorecard here, well, we got a point for initial jobless claims on the bearish side, and then we have a neutral point for unemployment. Okay, so now we move over to housing. First up, we have housing prices. And it seems kind of obvious when we look at this chart that clearly this is trending in the right direction. Generally, higher house prices are good for the broader economy. Now, this is obviously largely driven by the fact that we are in a low interest rate environment right now, thanks to what the Fed is doing. But either way, that's still a positive sign as far as pricing for houses. And then if we shift over to housing starts, well, it might not be too surprising that this economic indicator is also doing fairly well. This is, here they track the number of new houses being built. So the fact that this number is going up, is a very positive sign for the overall economy. Again, it's influenced heavily by the low interest rate environment, but still, that's a purpose of low interest rates, to get people borrowing, which gets more people in houses. So we're going to get 2 points for the bulls for those two. Okay, so that's a good thing. Now moving over to manufacturing. And when we look at this ISM manufacturing indicator, just so we're all on the same page, the key level here is 50. Anything above 50 implies growth in the manufacturing sector. Anything below it implies negative growth, which is clearly a bad thing. Given that we currently have manufacturing up here, well, that implies that the manufacturing sector is growing, and this is a good sign for the broader economy. Okay, so over to our scorecard. For manufacturing, we have a point for the bulls. So our scorecard has 2 negative points, 5 bullish points, and 1 neutral point. Now, I actually think that consumer confidence is a huge one. This one is I think this is the most important one out of all of the indicators that we're looking at, because the consumer drives so much of what the US economy does. So the fact that this one is still negative certainly gives us a reason to pause our optimism about the broader economy. But either way, the economy is certainly heading in the right direction, especially considering that we are in the midst of a once-in-a-100-year pandemic. So hopefully the economy continues to strengthen up as the months and 2021 goes on. Now, the real problem, as far as I see it, as far as the overall economy goes, is that it's not necessarily that this is strong or weak. I think that I would call this economy more of a neutral point if we had to rate the overall economy, considering the importance of consumer confidence and consumer spending. But ultimately, my concern is that the S&P 500 right now is trading at a PE ratio of about 30x, which is 30 times profits. That's way on the high end. So do we want to invest in a market where many, many things seem overpriced? Now, personally, I think it makes a ton of sense to continue to investing. I love dollar cost averaging, which is where you continuously invest the same amount of money on the same frequency. So every week, every month, every year, whatever it is. I think that makes a lot of sense. We ignore the price of the stock market, the price of the individual investments. We just keep continuously doing it. To me, that makes a ton of sense. Beyond that, I'm not sure it makes a ton of sense to be buying the broad market. If I owned something like VOO or SPY, which is S&P 500 ETFs, I wouldn't be buying any more right now. I'd be sitting and holding, because I do expect the economy to recover in the long run, but I'm not sitting there buying more of those. Personally, what I'm looking for is more individual investments that offer better opportunities given the current environment. So for me, to answer the question, do we invest now or wait for a crash? I think it makes sense to invest now strategically. If a crash comes, boom, then at that point we jump in and then we buy the broad market ETFs. But for now, I think strategic investing makes the most sense, or dollar cost averaging. Now, to take this one step further, my last video, I actually went through some different economic forecasts for 2021, and ultimately how that could impact the stock market through 2021. So if you're curious where economists are, what they're forecasting for 2021, perhaps that could be a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.